Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Impact of OECD Two-pillar Solution in Asia Pacific, Latest Developments and What to Expect. My name is Sanjay Kumar and I'm a tax partner based in Deloitte, India. I have the pleasure of hosting today's webcast. I have four speakers with me today: Jonathan Culver, Shefali Goradia, Benjamin Tausig, and Amelia Teng. Jonathan is a tax partner based in Deloitte, China. Shefali is a tax partner in Deloitte, India. Ben is a tax partner based in Deloitte, Singapore. And Amelia is a tax partner based in Deloitte, Australia. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related question, you can submit that at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your question during the presentation. Second, all PC users can maximize or minimize each box at their convenience during the webcast. They may also explore the icons at the bottom of the screen. If any PC user wants to download today's slides and related publications, please go to Downloads and Links box. On the other hand, mobile device users can view the slides and answer the surveys on the screen. Thirdly, if you require an attendance record for this event, you can download your CP credit by clicking the Request CP icon at the bottom of the webcast console. Now let me give you an overview of the topics that we intend to discuss. To start with, I'll give a brief recap of the latest developments on Pillar 1 and Pillar 2. Thereafter, we'll get into a discussion on four thematic issues with our eminent speakers from various parts of the AP region. These topics are withdrawal of digital service tax, as some AP region countries did introduce a digital service tax after BEPS Action 1 was published. We will discuss the impact on these digital service tax after Pillar 1 and Pillar 2 are accepted and finalized. Incentive regime, which is on the tax holidays, because that is our second theme for the discussion today. AP region countries have over a period of time introduced many tax incentives in their statutes. What happens to these incentives after Pillar 2? A question of eminent importance and interest to the audience, I suppose. The third one is about interactions with domestic laws and impact on minimum tax. This is another question of high interest. What changes countries are likely to make in their domestic laws? Questions are also whether controlled foreign company rules would be brought in by the countries. The fourth one is key outstanding on coordination issues. And there are a number of outstanding issues such as timing difference in the implementation to other technical issues. How should the business shape on that? We will cover all these questions with the speakers, and time permitting, we will take audience questions too. Let me move to describing a little bit on the Pillar 1. Pillar 1, as part of digital taxation, is a proposal seeking to allocate profits to market allocation. And Pillar 2 ends the race to bottom by establishing a minimum rate of tax of 15%. Significant to note, Pillar 1 and Pillar 2 are a package which though operate separately, but they have a combined impact. 136 countries out of 140 have so far agreed to the Pillar 1 and Pillar 2 proposals. Pillar 1 proposal will be experienced by the world's largest MNE, having consolidated global revenues greater than Euro 20 billion, and the most profitable corporations having profitability greater than 10%. Pillar 2 proposals will be experienced by large corporations having consolidated global revenues greater than euros 750 million. Pillar 1 proposal also entails removal of existing DST and other similar measures, and we'll delve in that a little bit more. So let me now move to giving you a little bit of idea of what the context of Pillar 1 and Pillar 2. The key proposals of Pillar 1 can be grouped into three components. Amount A, that's the new taxing right. It is a share of residual profit allocated to market countries using a formulaic approach to all in-scope businesses. Amount B is for marketing and distribution functions based on arm's length principle and is applicable to all businesses. The third aspect is tax certainty, and that is having effective dispute prevention and resolution mechanisms, and that is applicable to all businesses. Amount A is to be allocated to the market jurisdiction only if nexus exists. It is applicable if a business has a sustained and significant involvement in the economy of a market jurisdiction. The level or existence of physical presence in the country is not relevant. Market revenue will be identified and measured per the revenue sourcing rules. Amount B aims to standardize remuneration of the related party distributors that perform baseline marketing and distribution activities. That is, it is understood that will be aligned with the arm's length principle. Further work will be done on this and will be completed, I suppose, by the end of 2022. Market amount A is predicated on removal of all digital service taxes and other similar measures on all companies. As I said, we will discuss this later during this webcast. Let me move to Pillar 2. As I mentioned, is designed to ensure that large internationally operating businesses pay at least 50% tax, regardless of where they are headquartered or the jurisdictions they operate in. In situation where the effective tax rate paid by an entity in a jurisdiction is less than 15%, Pillar 2 envisages to recover the balance as top-up tax from the M&A group. Pillar 2 rules are divided into two parts. First one is the GLOBE rules, or Global Anti-Base Erosion rules, a top-up tax to a minimum rate. It includes income inclusion rule, under-tax payment rule, and switchover rule. The second one, second part of the Pillar 2 is subject to tax rules, a rule that applies in priority to GLOBE rule and may deny treaty benefits on certain passive related party payments. Under income inclusion rule, top-up tax could be payable in respect of the low taxed profits of foreign consolidated entities, similar to the operations of a CFC rule. Under-taxed payment rules would operate by the way of denial of a deduction or imposition of source-based taxation for payment to a related party where the recipient did not meet the minimum ETR. So income inclusion rule is the principal mechanism to achieve GLOBE rule outcome, and the undertaxed payment rule acts as the backstop or a secondary rule. Switchover rule is to be introduced in tax treaties that permits a residence jurisdiction to switch from an exemption to a credit method when profits attributable to a permanent establishment or that coming from immovable property are subject to a rate below the minimum rate. Subject to tax rules adjust the eligibility for treaty benefits where payment is not subject to tax at a minimum rate. Unlike the income inclusion and the UTPR, it applies taxation on a payment rather than a net profit basis. We will discuss more with the speakers as per the thematic topics I mentioned in the agenda. Before I do that, I have a polling question for you. The question is, has your organization considered how it will obtain the data for Pillar 2 calculations? And possible responses are, existing systems expected to easily provide data, obtaining data will require manual processes, existing systems will provide some data with additional processes expected to be required. The fourth one is unclear and expect this to be a significant challenge. And the final one, the fifth one, is don't know, not applicable. And you need to select only one response. Let me ask Jonathan, while we are waiting for the results to come in. Jonathan, I understand that there have been some developments and proposed simplifications with regard to information required for Pillar 2. What has
That's right, Sanjay. And apologies for the background noise. So basically, previously there was this anticipation under Pillar 2 that we'd be required to have stat accounts prepared in the accounting standard of the UPE jurisdiction. It now looks like that's been substantially relaxed, and so we'll probably be able to have accounts prepared in the local jurisdiction. So basically, we can rely on the accounts that are prepared, naturally as a part of everybody's standard reporting processes. So I think that will really, significantly simplify the compliance procedures. And I have to say, I think it was probably quite unworkable actually for people to, really be expected to prepare stat accounts in the UPE standard, because that would have just required a huge amount of extra effort and duplication. So, I think that seems to be the direction, and you're allowed to do that, provided that there's no material deviation in terms of the, in terms of the accounting profit. So I see the poll answers will come up now. So I'll go back on mute and let you continue.
Thanks, John. I see that 45% of the people have said that the existing system will provide some data with additional processes expected to be required. 24%, which is feel that it's unclear and expect this to be a significant challenge. 19%, which is almost like 1/5, don't know and is not applicable. And a very small percentage of the audience says that existing systems expected to easily provide data, and about 10% obtaining data will require manual processes. So that is the summary of the question, the responses which have been filled in. So let me now move to the theme-based discussion that we said that we will do. As mentioned earlier, a number of countries in the AP region are seeking to implement digital service tax or have implemented. Many countries like India, Indonesia, Malaysia had introduced their own digital service tax. While signing on Pillar 1 and Pillar 2, many of these countries have agreed to repeal these unilateral measures targeting technology companies. We discuss now how will that impact the AP companies, the Asia Pacific companies? Let me move to Shefali. Now, Shefali, India did introduce the equalization levy, and now that there will be a pressure and there is a commitment by India to remove EQL, what is going to be the impact of that?
Thank you, Sanjay. Yes, I think India has already given its commitment to withdraw the EQL. And as soon as the pillar proposals are in implementation mode, India will be withdrawing equalization levy. I think the impact is somewhat uncertain as of now. While it is expected that out of Pillar 1, there is a reallocation to market jurisdictions almost to the extent of $125 billion. It is expected that at least maybe 1 to 2% of that might come into India's share. Against that, India is already currently collecting somewhere in the region of $500 million as equalization levy. So it will kind of marginally increase its kitty, but it is uncertain as to whether it would really increase India's revenue share significantly. But at the same time, as we know, both Pillar 1 and Pillar 2 are tied together. And how all the different countries react to the Pillar 2 proposals, what domestic law changes are made, I think that will determine, how much incremental tax revenue countries like India would get. Considering especially that out of Pillar 2, there is an expectation of $150 billion of tax revenue being collected incrementally. Surely some of that would go into the developing countries' share. And countries like India already have a higher withholding rates. So more likely that, for the under-tax payment rule, once that kicks in, if they get an extra right to tax any additional income, that might add some amount of tax. But it all depends, on how the different countries adapt their domestic law to implement Pillar 1 and 2.
So, Shefali, as I understand, you are saying that it's still maybe whatever they are getting, that much could come back to India.
And a little more. But how much more, I think, it is still, these are still numbers. Yes.
No, thanks, Shefali. Let me move to Emilia. Emilia, Australia does not have a DST per se, but what are some other similar measures in Australia that companies might argue should be included in the standstill?
Thanks for that question, Sanjay. It's an interesting question because the definition of DSTs and other similar measures is just one of the items that the OECD hasn't really provided any clear detail on. We know that the politics of Pillar 1 are about this reallocation of taxing rights in exchange for the cessation of unilateral measures, but countries have unsurprisingly been pretty quiet about what they might give up in exchange for Pillar 1 beyond just DSTs. I mean, we've had countries like Canada bringing a DST into force that will only have retroactive effect if Pillar 1 fails to come in. So naturally, I think there's a lot of hesitancy when it comes to repealing existing rules. But from an Australian perspective, there are actually a number of anti-avoidance measures that were implemented around the time of the first BEPS project. And whilst these rules are not technically limited to digital businesses or technology-focused businesses, in practice, those are the ones that are by far the most affected. So we have a twin set of rules called the Multinational Anti-Avoidance Law, which is a deemed PE rule. And we also have a diverted profits tax rule. And these rules have been responsible for companies restructuring their business models in Australia and bringing quite significant additional revenues into the Australian tax base since 2016. In addition, the Australian Tax Office, the ATO, they've recently launched some new guidance in relation to how they would characterise software, distribution payments for withholding tax purposes. So again, it's not exactly a digital services tax, but I think businesses entering the Australian market are quite rightly sort of asking questions around whether or not these rules should continue to apply if we do have Pillar 1 introduced, or perhaps, what kind of credit or anti-overlap mechanisms should apply once we have Pillar 1. And I think that all of those details, obviously, people are keenly watching how things are implemented at a local level.
Okay, thanks, Amelia. Let me move to the next topic, which is on incentive regime. And if there are many jurisdictions in the Asia-Pacific region offer a wide range of tax incentives to attract foreign investment and to drive the development of local infrastructure and similar such measures. These can be summarized. These have been summarized on the slide deck. And however, the introduction of a global minimum tax raises questions on the future of such incentives, with government agreeing to move on the BEPS reform. What will be that the government is going to do as a policy response on these incentive regimes? Let me go to my experts on this aspect. So let me turn to John. John, Hong Kong has various incentives that provide for a 8.25% tax rate. Looking at mainland China, there are several incentives offering a tax rate 15% or less. In some cases, with super deduction, how will these be affected? How will the government going to organize itself in a policy measure?
Sure. No, thank you, Sanjay. And I think this is a very good question, right? And effectively, what we have to some degree is a little bit of a straitjacket been put on certain jurisdictions and their ability to craft fiscal policy through this global minimum tax. And so, while the global minimum tax itself, of course, does not require any change of legislation from any country, as a matter of simple operation of the tax, where a significant tax holiday or incentive is offered by a particular jurisdiction, in general, what we'll see is top-up tax being collected in a UP jurisdiction where the jurisdictional rate of tax falls below 15% under the global minimum tax rules. So we effectively see these tax incentives, these tax holidays, to some degree being obviated, made completely redundant by this rule. Now, if we think about what jurisdictions can do to respond, I think to some degree their ability to respond is relatively limited, right? So, Hong Kong in particular, I have to believe was, perhaps one of the intended targets of this kind of global minimum tax. And so, it's been quite difficult, I think, throughout the development of these rules to have any positive influence on these rules from the perspective of improving them for Hong Kong. So really what we think about from Hong Kong in terms of response is, well, can we do anything to, effectively shift the collection rates? Okay, so if we think the UP jurisdictions, they might be predominantly European, it might be mainland China, et cetera, et cetera. Of course, the US has guilty already, and there's a coordination discussion there. What we can at least do, I think, in Hong Kong, and what the government, of course, is very closely looking at, is introducing this concept of a domestic minimum tax, which I think we can discuss a bit more later. But that is effectively a tax which is, broadly aligned to the globe rules, and which will be overlaid on top of our existing territorial regime. And the concept there will be, if you're a company that qualifies for Pillar 2, that qualifies for Globe, and therefore you would pay top-up tax somewhere else, you'll simply simply calculate your tax under ordinary Hong Kong domestic tax rules, and then you'll also calculate them under domestic minimum tax rules, which are essentially Globe rules, and you'll simply pay the higher of the two. And so this should allow at least Hong Kong to benefit from this tax rather than another jurisdiction. Now, of course, that's not necessarily hugely beneficial from Hong Kong's perspective in terms of negating the negative impacts that this tax might have on investment. And so I think, the Hong Kong government will need to think hard about how it can craft incentives which are meaningful, which aren't directly countered by this rule. And I think we'll see that in the future. Hong Kong will also have to spend a little bit of time considering how it can align its existing tax system more closely with these globe rules. For example, some parts of the globe rules provide for alignment with tax depreciation and so on and so forth. Hong Kong already has a very good tax depreciation regime, but there'll be some areas where alignment with domestic laws could mean that domestic laws could be relaxed and improved, and that could make a place like Hong Kong more attractive as well. When we come to mainland China, you make a very good point. Two incentives in particular, a 15% tax rate, but with super deductions. Now, I think China has had a hand in crafting these rules, and of course they are very powerful, and they have been able to make certain carve-outs, I think, that will benefit China. And we do wait to see what the final rules will say, but particularly with regards to super deductions, we may see an ability to align with domestic law, and that may play favourably to the China incentives. So I think we need to wait and see there, Sanjay. But I think there are some response measures and some threads in the bow of governments that they can draw on.
Oh no, I think, Jonathan, you have really laid it out very well, because this is a question of not only from a tax point of view, but it's going to straddle many other areas. And I do appreciate your response, which was very detailed. Thanks a lot, John. Let me turn to Shefali. Shefali, India has a large number of shared service centers. When they were set up, they were offered certain tax holidays. What is likely to happen now, considering the global minimum tax of 15%?
Right. So, of course, the tax holidays and the incentive regimes are all under scanner. But as far as India is concerned, there is already a sunset which has been set in, right? So I think most of the holidays are already in the expiry mode. And only the units which have already been set up before and they have an unexpired period, they are continuing. India already introduced a minimum alternate tax, or a MAT, equivalent to 15% base rate on the SEZs. So the companies were already paying that base minimum tax, so they are not really likely to be impacted. The only impact could be on the IFSC, or the International Financial Service Center, or the GIFT City, as we call it. These centers, which were set up especially for the financial service industries, any units which were set up in the GIFT City, they continue to enjoy an even more concessional regime, where while they did enjoy the tax holiday, but the minimum alternate tax that was applicable to them was half of the then prevailing MAT rate. So currently, the MAT applicable to these units is only to the extent of 9%. And to that extent, they will definitely be below the 15% rate. Now, this is where probably we will have to see how do companies really are able to apply the jurisdictional blending. If they have other entities in India which are paying tax at a higher rate, and then there are these subsidiaries which pay a lower rate, maybe their effective blended jurisdictional ETR could still be higher than 15%. And in such case, they should be okay. So this is again going to be, looked at by, from a company to company basis. But what will be India's reactions in relation to this continuing tax incentive? I think we will again have to wait and watch to see what happens. Unlikely India will withdraw anything at this stage, because it has been very actively promoting this IFSC tax region. And if the companies or the units have already been set up, they've already made commitments to build a local infrastructure, unlikely that India would really completely withdraw that. So two possibilities. One, we keep the status quo and let the home jurisdiction collect the extra top-up tax. Or second, possibly, India increases the 9% MAT to at least a minimum level of 15%. But we'll have to wait and watch.
Thanks, Shefali. Let me ask you a follow-up question. My mind is going to the patent box regime. India brought the patent box regime, I think, in 2016, and certain concessional rates were charged if someone exploits its patent by availing of the box. What is your view on the patent box regime? and the
Right.
tax rate.
So this is also, yeah, sure. So this is again somewhat more of a work in progress yet. It is possible, and as we've seen some of the statements when OECD released, that some incentive regimes are already likely to be considered while working out your ETR. And if these, these type of regimes, which are only applicable to one particular stream of income, right? So if it's only applicable to the royalties or fees for usage of IP, possible that the effective rate could anyways be higher than 15, and then nothing more will need to be done on this. So this is something that we'll have to wait and watch, but quite likely that OECD has already acknowledged that some of these incentive regimes may be factored in while calculating the ETRs.
Thanks a lot, Shefali. That was quite detailed, that exposition that you gave on the, the incentive regimes. Let me turn to Ben. Ben, Singapore has capital gains exemption and various other incentives that provides tax rates ranging from 5% to about 12.5%. How will these be impacted or affected?
So again, Sanjay, I think it's a similar story to what we've heard from Jonathan and Shefali. That clearly this is sort of an approach the international community has taken to ensure that groups pay a certain minimum level of tax. The Singapore government have not said anything officially in respect of what they will be doing in respect of this. They have, however, made a few sort of broad policy statements around the direction of travel. I think one of the points to note is they've noted there's about 1,800 multinational entities that are likely to be subject to these rules, so the Pillar 2 rules operating in Singapore. And they've said that they expect most of them to be at or below the 15% ETR in Singapore because of our source-based regime, R&D incentives, etc., and also more generally some of the incentives that are available. Singapore has said that it will abide by the international rules, that it will look to minimize sort of compliance burden for business and safeguard taxing rights. When you combine those three principles, again, it seems to point to a domestic minimum tax. Having said that, we'd also expect Singapore to still encourage groups to come to Singapore and invest in Singapore and increase economic activity in Singapore. So to the extent that there are incentives and incentive regimes that are on the statutory books today, I think it's very likely that they'll still continue to be on the books and available to groups going forwards. Again, there's jurisdictional blending. There's also groups that may not be subject to the Pillar 2 rules. And Singapore wants to encourage investment into Singapore and still would prefer to use fiscal policy as one of those reasons, as one of those measures to encourage that investment. So to sum it up, I think in Singapore, we're likely to see some form of domestic minimum tax, similar to Hong Kong, although again, no official statement from the Singapore government, and similarly likely to see incentives maintained to enable certain groups to still benefit from them.
Oh, thanks a lot, Ben. Well, there were questions on that about Singapore, and you have really laid it out well. Let me turn to the second polling question of the day. And the question is, how soon your organization will undertake reorganization or structural changes to align with the OECD changes? And the options are already underway. Second one is within 1 year. Third one is after the end of 2022, because by then certain things, particularly on the arm's length that I mentioned, will also be there. And the fourth one, not likely. Please select only one response. In the meantime, while you are filling up your responses, let me turn to Amelia and ask her a question. Amelia, how are companies in Australia currently responding to the OECD proposals?
It's a little bit of a mix in my experience, Sanjay. Mostly it's a case of wait and see what happens. But most companies are interested in what local implementation of Pillar 2 will look like. People are very conscious of the short timelines for implementation and wary of inconsistencies arising if it is rushed on a unilateral basis, I guess, and waiting to see whether all countries implement compliant regimes that do, in fact, meet the exact standards of what the OECD is proposing. Of course, we have to have local legislation in every country, so there is a risk that the nuances or the intricacies in local laws may differ and put paid to that principle that we have a consistent compliant regimes. I think in terms of structural changes, it's probably too soon to see that starting from an Australian perspective. So it'll be interesting to see how our audience responds today.
Thanks a lot. So I have the response. About 32% say that after the end of 2022. It's quite understandable. About 20% say within a year, and about 13% say they're already underway. So they are going ahead of the curve. The rest of it, and not likely is about 15%, which is a very good distribution. So let me turn to the third theme, and this is on the interaction of domestic laws and impact on minimum tax. This is certainly an open area, and there are many aspects which require clarity. One of the clear questions for deliverance is on how Pillar 1 will interact with the existing CFC rules and other domestic laws. How will there be simultaneous operations of Amount A and the existing treaty? Will there be a separate MLI to facilitate the implementation of subject to tax rule? US also brought a different rule, tax rule GILTI, and I think John mentioned about that, or global intangible, that GILTI is global intangible low tax income. The rule was brought in about 3-4 years ago. Under this, a deemed amount of income derived from CFC in which a US person, and when we take person, this is within inverted commas, is a 10% direct or indirect shareholder gets taxed. If it is computed roughly by determining the taxable income or loss of a CFC, as if the CFC were a US person. Question on the coexistence of the globe rules and the GILTI are also being raised. Let me ask panel here and ask questions on what measures are likely to be taken by each country with respect to interaction with its own domestic law, or including treaties, actually. So let me turn to Emilia. Emilia, how do you think the domestic minimum tax in the region will impact companies, or let us say Australian companies?
Yeah, well, thank you, Sanjay, for the question. I find this idea of a domestic minimum tax that both Jonathan and Ben have commented on an interesting potential response to Pillar 2, actually. For example, Australia already has a form of a UTPR as it relates to intragroup financing, for example. It's basically a deduction denied rule that applies to interest that isn't taxed at more than 10% offshore. And this is a rule that was introduced along with our hybrid rules in the first round of BEPS. So what it makes me wonder is that if domestic minimum taxes are introduced and if they are treated as a relevant covered tax and imposed on the same basis as the globe, it is possible that they'll deal not only with Pillar 2 outcomes as intended by the OECD, but they may also be helpful at protecting against some of these other measures which Australia has introduced, which may have been impacting related party financing structures, particularly those that come via Hong Kong and Singapore Treasury centres, for example.
Thanks, sir. Amelia, I understand Australia has a well-developed CFC rule, and that is also for quite some time. How do you see the income inclusion rule interacting, and what sort of things are Australian companies thinking about in terms of the onset of the new IIR rule?
Right. So CFC interaction is a big issue playing on companies' minds, I think. For Australian companies, the CFC rules impose quite a hefty burden from a compliance perspective, as well as from an income pickup perspective. Most passive income and other base eroding payments will already be collected under our existing CFC regime. So the income inclusion rule might have a limited application from a technical perspective, But the calculation, of course, is vastly different. CFC rules operate on an Australian tax basis, whereas, of course, the income inclusion rule or the GLOBE rules are based on financial accounts. So I'd envisage that there'd be a lot of complications coordinating the two sets of rules from a technical perspective. Then, of course, there's the OECD's policy on how taxes are allocated down on a country-by-country basis, and this is an important technical point. The principle per the OECD's blueprint will be that the CFC tax is pushed down to the local level of the actual CFC, which is subject to potentially a cap of the 15% minimum tax, as well as there being a limitation on the profits, which are actually within the Pillar 2 globe base. So there's a fair amount of coordination issues. I think that countries in the region like Australia, like Japan, which also has CFC rules, will really be looking for clear guidance from the OECD on how the IIR is meant to interact with CFC regimes, so that there's really consistency across the board, which is obviously one of the key objectives of these rules.
Quite an interesting time, Amelia, because so something which was already there, now there's a new set of rules, and then how this will enmesh together. All these are very interesting things. Shefali, just one very quick question to you. Any possibility of CFC rules in India?
So, Sanjay, I think, again, a little bit of crystal ball gazing for all of us from India. CFC has been on the cards for a while. It was there in the draft Direct Taxes Code bill when that was introduced, but it somehow never saw the light of the day. And I think currently, India would have two choices, right? Either it will wait to see, how the model rules come out and, whether if there is a way for it to implement a more simpler CFC. Or the other choice could also be that OECD has already given some leeway to the countries where income inclusion rule currently applies only to companies which have consolidated revenues of more than 750 million euros. But the countries are free to apply it to smaller companies as well. So other possibilities, you could just reduce the threshold for the Indian headquartered companies and apply the income inclusion rule. So again, probably we'll have to wait to see how, once the globe rules are out and the model, text as to how they have drafted, probably based on that, India would take a call on whether to introduce CFC or just adopt a lower threshold for the income inclusion rule.
Sure, Shefali. In any case, India was thinking at the time when they were, bringing the direct tax code. There was a particular section on the CFC rules, but which was never implemented. So they have some basis to organize them. Let me turn to John. John, I heard you on the aspect of domestic minimum tax being introduced. Any idea what will that look and what will be the key considerations?
Sure. Thanks, Sanjay. So I think this one is, again, it's another good question. Actually, it gets into some of the complications of these rules and how they might the interplay between things like the IIR, the UTPR, and so on and so forth. So I actually, understand that domestic minimum taxes, as a general concept, are relatively popular at the moment. So, so much so that I understand that the IF at the OECD has actually turned its attention to ensuring that, domestic minimum taxes, if they are implemented by jurisdictions, that the jurisdictions are given some guidance into how to implement them, so that it can be, there can be some sort of regulation around it, so that we can ensure that the domestic minimum taxes really do represent covered taxes. And so, if we think about Hong Kong, for example, there'd been some question about whether it would be possible to have a domestic minimum tax that just applies to inbound companies, but does not apply to companies headquartered in Hong Kong. Why would we want to do that? Well, because we have a lot of companies in Hong Kong that do have their headquarters here, that take the benefit of our various, tax incentives, territorial regime, etc. And we might want to preserve the low taxation of those companies, right? So if we think the IIR only applies to the rest of the group outside of the UPE, how do we tax the headquarters? well, the headquarters is taxed under the UTPR, right? But the UTPR is delayed by 1 year, right? So if we didn't include UPs in the domestic minimum tax, we could potentially give their profits a break for 1 year. Now, similarly, the UTPR, right? There's been an exemption included in the UTPR for 5 years, where you have relatively low amount of assets, 50 million euro equivalent, overseas, and you only operate in 5 jurisdictions or less. So you can have a 5-year break from the UTPR. So actually, there's quite a lot of benefit to be had if you could have a domestic minimum tax that does not apply to the UP jurisdiction. So I think Hong Kong and I expect a number of jurisdictions will be, wrestling with this issue at the moment and considering to themselves whether, actually they can have this without kind of discrimination. And they'll also be, of course, interested in the OECD's views. So, I think there's quite a lot of complexity here, and there's a lot for different companies to unpack and get to grips with. And it'll be very interesting to see how it unfolds.
Oh, thanks a lot, John. Ben, what is your view on the similar question that I put up to John, and anything that you would want to say from a Singapore perspective?
Thanks, Sanjay. So rather than repeat some of Jonathan's comments again with regards to the design features, I think what would be interesting is to think about how are groups going to implement this in practice, and then also similarly how are tax authorities like the Singapore tax authorities, the IRAS, going to look at this. So when I think about it in the context of Singapore, Singapore does not have consolidated filings from a tax perspective. It does have a group relief rule, but that group relief rule is relatively restrictive around the ability to transfer losses within a Singapore group. So the domestic minimum tax, if it is introduced, would, again, like Jonathan said, be based on the IIR, which is on a jurisdictional basis. So this would be a significant change to the way groups have done compliance in Singapore for tax purposes. They need to get data from across the multiple different operations they might have in Singapore, different business units with different CFOs, and would need to consolidate all of that and report it and have one entity that's responsible for reporting tax on behalf of all of the other operations in Singapore, which again is a significant change to the way groups do business. Similarly, the tax authority would have to potentially change its approach to compliance. How is it going to audit these numbers? How is it going to get the detail across multiple business units and check? So I think tax authorities are going to have to think through the auditability of any domestic minimum tax, and groups are going to have to think through some of the changes they might need to make to their compliance processes in order to comply with the domestic minimum tax.
Oh, thanks, John. So there are many issues. So based on what I heard from the panel and the material, the OECD material, it's quite clear that there are many technical and mechanical rules which are yet to be developed. So it is important that we identify what the key outstanding issues are and how are the AP countries planning to deal with the same. There will be similarity of approach, if not the same. So in the interest of time and with a view to not repeat the questions, may I ask the panel to pick up one of the key bullets on the screen and give their perspective. Let me start with Amelia and request her to give her perspective on timing differences, Amelia.
Sure, thank you, Sanjay. Thank you, Sanjay. The question is really, how do you implement a global minimum tax rule that is based on financial accounts without inadvertently unwinding deliberate fiscal policy settings that countries have chosen that really only impact the timing recognition of income and expenses? So that's what timing difference refers to. Typically, the example given is for accelerated depreciation for tax purposes, or perhaps instant asset write-offs that incentivize capital investment. And in the blueprint, the OECD suggested that some limited adjustments be made to the Pillar 2 or Globe base, and that the ETR be calculated by reference to the taxes paid on a country-by-country basis, and that if any timing differences were unwound by this mechanism, then they would create a tax carry-forward credit. I think it was implicitly assumed at that time that, if the accelerated depreciation and fixed asset differences were taken out of the base, then these would be quite minimal. But an alternative approach, which seems to have garnered some traction, is to use deferred tax accounting to determine the ETR on the country-by-country basis. So rather than make adjustments to the actual base, deferred taxes would be used in the ETR calculation, but they would probably be limited to those that unwind in an agreed period of time. It's yet to be seen what that might be, 3, 5, 7 years, who knows, or relate to an agreed set of assets. And I think this is one area that people have been keenly watching develop, because it goes to both the tax impact of Pillar 2, as well as to those compliance aspects of doing the ETR calculations and the access to information and source of data, etc. Another key adjustment I see on the slide it's been flagged is obviously pre-regime losses. Perhaps I'll pass over to Jonathan, I think, to comment on that one.
Sure. No, thanks for that, Amelia. So pre-regime losses is very simply losses which are recognised for domestic tax purposes that are incurred prior to the introduction of the globe rules. So the question here is, can you take the benefit of those losses into the globe rules and effectively offset some of your income, your globe income with those, right? So that where you don't pay local tax because of those losses, that's reflected in the globe result as well. Now, there's some tension around this because in the blueprint, basically there was a section on pre-regime losses that suggested that only those losses incurred 2 to 3 years prior to the introduction of globe rules would be allowed, and only those losses from in respect of operating losses would be allowed. And so, of course, there are some sectors, for example, the banking sector in Hong Kong that has really significant losses going back, well over a decade now. And so the disallowance of pre-regime losses could have been really significant. And so actually a lot of fuss was made about this in the public consultation, and a lot of lobbying has happened behind the scenes. And it now looks like, I think directionally it's more likely that we will have access to pre-regime losses in their entirety, although it does seem that there'll be a need to recalculate those pre-regime losses in accordance with globe principles. So I think that the general headline is, extremely good news and extremely positive for those people with significant losses. And let's just wait for those final rules out to confirm that is in fact the case. Ben, maybe onto the industry matters for you to cover off.
Thanks, Jonathan. I know you mentioned that the banks in Hong Kong. I think sort of the financial services industry has spent a lot of time reacting to these proposals, and they've had some successes. So they've been able to influence behind the scenes certain matters, but there are some which are still uncertain and whether there's going to be the right fix. So, for example, one matter that's been sort of discussed a number of times by the industry is the position of investment funds. So, currently, where you have a in the current blueprint where you have a investment fund where it is not consolidated, so the fund vehicle itself is widely held, it's not consolidated, it's the ultimate parent entity. There are certain sort of exemptions from these rules with regards to that, similar to what is the case for the CBCR rules. Then the issue is what happens where you consolidate an investment fund. And if you think about the insurance industry, it's very common for life insurers to pool policyholder, also assets backing policyholder liabilities, to pool them and to place them into investment funds. The reason for doing so, it's a tried and trusted method to pool investments and to get certain degree of flexibility, commercial. There's no mischief that is there or designed to be there. But typically, there's a pickup at the investor level, so at the insurance company level, and there is exemption at the fund level. Unfortunately, if there isn't some tweaks to the rules, we could end up in a situation where that principle of taxation at the investor level and exemption at the fund level won't apply, and we might end up in a situation where there's tax at the fund level. Tax at the fund level could significantly impact the life industry, where those investment funds are backing participating policies, and where actually the insurer is not entitled to the associated investment income, but yet is paying the tax. So something that the insurance industry is still hoping will get tweaked, and is spending a significant amount of time and effort on. I think just in the interest of time, I'll pick up one more issue that's relevant to the financial services industry, which is around regulated capital securities. So if we think about some of the responses to the financial crisis, there's been further strengthening of the regulatory requirements with regards to capital, and has led to banks and insurers being encouraged to issue certain types of regulatory capital securities. These securities previously would have been debt-like from a tax perspective, and debt-like from a equity, from an accounting perspective. However, in a number of jurisdictions, these securities are treated as equity for accounting purposes and debt for tax purposes. That has a significant impact on the IIR calculation, and is a piece where the financial services industry worked very, very hard to get that tax treatment, but to reflect the economics that were in place prior to the change in rules. And now that position may be eroded. So the industry is looking to see whether it is at all possible to maintain that treatment, and continues to lobby hard, and wait and see what the final outcome will be. Sanjay, if I pass back to you.
Thanks. Let me ask a question to Shefali. Any comment on the dual regime or optional regime, Shefali?
Right. So, Sanjay, and this is something that has been in discussion and also somewhat anticipated. Many of the jurisdictions which were offering lower tax regimes, they are contemplating, having a dual or a parallel system, where all the in-scope large multinationals could be subject to a minimum tax of 15%, but the smaller ones could still continue to enjoy the incentive regimes. So there are multiple things under considerations, whether countries should go for the dual regimes and are they acceptable, or what about optional regime, where the companies can opt to fall or to choose for one regime versus the other. Will they still be, will they qualify, and will they be in compliance with this two-pillar solutions? So I think, again, this is something that we would wait to hear more from OECD, but it is under consideration, and some of the European jurisdictions are actively considering these options.
Thanks, Shefali, and thanks to John, Shefali, Ben, and Amelia. And this brings us to the end of our today's discussion. We'll now have some time to respond to questions from the audience. Let me turn to one question which says, it seems as though India will have to repeal equalization levy due to the new OECD agreement. Do you agree? And if yes, does that mean that we would no longer be subject to or to it as of October 8, 2021, or we will still subject to it until December 23, 2023?
Right. So Sanjay, as you know, I think in the Indian context, while EQL will be withdrawn, but India has not come out with any clarifications as to whether it will be willing to give credits or offset, unlike some of the European jurisdictions. And therefore, it is not expected that it will be withdrawn with effect from October 21, when this pillar solutions were agreed upon. Quite likely that once it is implemented from 2023, that's when the EQL will stand withdrawn. But we are not expecting that till then, which is the period from October 21 till say December 2023, you will still have to continue to pay equalization levy as you have been doing in the past.
Thanks, Shefali. There's one more question that we can take, I suppose. What happens where the entity enjoying the incentive or incentives are in the same jurisdiction as the UP? Would this mean that the UP would pay the top-up tax for each of the incentive companies within its own jurisdiction, despite the fact that there is no shifting of profits? So let me pop this to Jonathan. Jonathan, can you take this question, please?
Yep, sure. No, thank you, Sanjay. And I think it's a good question. I think the base case for this is perhaps the easiest way to explain the answer is just to lay out how to approach the globe calculation. And that's, step one is calculate top-up tax, right? And you do that throughout the entire group, including the UPE. And then step two is collect top-up tax by way of income inclusion rule. And step three, collect top-up tax by way of UTPR, right? So in the question that you just outlined, the UPE would end up with a low tax overall because of these incentive companies. And so there'll be top-up taxes due, okay? But then we would look at collecting that. And under the IIR, well, that doesn't apply to the UPE jurisdiction. It only applies to subsidiaries. So that doesn't apply. But then we look at the UTPR, right? And so in this example, and it does depend on the final details of the UTPR and the specifics of the group, but in this example, the top-up tax would be collected by those subsidiaries under the UTPR rather than by the UPE jurisdiction.
Oh, thanks. That is all time we have today on the webcast. John, Shefali, Benjamin, and Amelia, thank you. Special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the debriefs website. We will respond to all questions submitted during the webcast in a couple of weeks. Also, if you think of any other question or comment later, please feel free to reach out either to me or to our speakers. We'll be more than happy to talk to you. Please do not forget to tune in to our next scheduled webcast from the transfer pricing series on 18th November, titled Australia, ATO Guidance on International Intangibles Arrangements. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.